Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster. Thrilled to be joined by David Barr today. David is the president and portfolio manager at Penderfund Capital Management. As a reminder, nothing in this podcast is investment advice. Nothing's an invitation or solicitation to buy or sell any of the securities mentioned. This is for entertainment purposes only. Please remember to do your own due diligence and consider everything that we say opinion-based. So with all that out of the way, Dave, how you doing, man?
I'm doing well. How about you, Bill?
I'm good. I have not featured a Canadian small cap activist, quasi-activist manager, and I couldn't think of a better one than you.
Thanks, Bill. I'm kind of surprised this is for entertainment purposes. Like my wife definitely would not agree that this is entertainment, but I'm glad some people might enjoy this.
There's a subset of nerds out there like yourself and myself that I'm just trying to deliver some entertainment to.
It's great to be able to do this.
You know, it's wild that the world that we're living in, not only could COVID occur, but with the advent of technology and different mediums and whatnot, I've been able to connect with more people than I would otherwise. Obviously, it's because of this podcast, but it's just what an incredible time to be alive. Buffett talks about he was just born at the right time. I mean, if I'm born at any other time, I don't have a podcast, right? It's just like kind of the right confluence of events.
Yeah, well, like Buffett, if we were born in like the 1500s, we would be like fodder for everything else out there right now, right?
Yes. Yes, there would be no way that I would have survived in a true survival, go out and hunt your own food world. I'm built to carry things. I'm not so much the kind that can chase them down.
Yeah. Well, I'm like 5 foot nothing, 100 nothing. So like, I don't know what use I would have had like 500 years ago, but I'm sure I would. I'm sure I would have figured it out. That's kind of what I do now.
Perhaps we could have both been fishermen or something like that, standing at the side of I don't know. Anyway, I digress. So, Dave, you want to give people a little bit of background on yourself? We met at Manual of Ideas. Shout out to John. I always like to give credit to John. He's brought me in touch with a lot of good people. But we met the first time was across the pond in Europe, right? In Switzerland.
Yeah, at the Zurich project.
Yeah.
Also, it's John connecting us. And I mean, I love, shout out to John. I mean, it's just such a great community he's built, and getting to meet you, and it was great. And I love the success you're having now, because I remember the first time I met you, and we start chatting, and you're so passionate, and I'm like, I just want to talk about stocks with this guy all day. Like where can we get a beer and continue this conversation? And I think that's really like part of the reason the podcast is so great, because you're so engaging and charismatic, and people love chatting with you. So it's great to see. I love being an admirer from the West Coast.
Well, I appreciate it. I do hope that all the listeners understand that I really may not know anything. That's not just false. I mean it when I say I'm just a retail guy that happened to stumble into a pretty damn good network. And I owe a ton of it to Twitter and a ton of it to John. And, a lot of it to the guys, the greats that sort of came before me. I tweeted out recently that I thought Curate was either the best thing or the worst thing that happened to me. And I do think that the world that you play in, the smaller stuff, is really intriguing to me, because I do think that like where I might have an edge on other people is the ability to network and get in contact with people and do sort of the stuff that I think a lot of finance actually doesn't really enjoy doing, which is like a lot of the interpersonal skills. And I think small is probably where I should have been focused for a long time, but whatever.
Well,
it's worked out.
I'm totally biased. I'm a small cap guy, but I'm going to challenge you. You kind of made the statement, I'm just a retail guy, and I don't, who knows if I know anything. And like some of the most thoughtful investors I know who do the best work are individual investors looking at the micro cap and small cap space. And it's a space. I mean, I've been in the space for 20 plus years. There's not a lot of information out there. And you kind of talking about how you love engaging with people and chatting and gathering information. You can there's not a lot of sell side coverage on these things, and a lot of people talking about it. So when you have these skill sets, you can go out and get information on these businesses. And the big institutions that are geared up to do it, I mean, they can't buy a $50 million stock. I mean, if you want to own 5% of a company, it's a $2.5 million investment. You're running $1 billion hedge fund. I mean, that's someone's annual bonus, right? They're not putting it in a microcap stock.
Yeah.
So I mean, the microcap, small cap space, we obviously love it. And I think to your point, though, it is actually an attractive place for individual investors. And I know I listened to your pod with Ian Castle, who's just a great proponent of this space. And I mean, I can't say anything because he just says it 10 times better than me. So I'll just stop there. Ian, thank you. Thank you for all your hard work out there.
Yeah, I think something that's cool. I joined Microcap Club, and I just sort of, I peruse. I haven't submitted an idea yet or anything, but the quality of discussion on that particular forum is very high quality from what I can tell. And it's kind of cool to see, I don't know. I mean, I guess it's like any community of people that are sharing ideas, but the microcap space is really interesting. And I do think it's one of those few places where you can actually have an informational edge. And a lot of it seems to be, to me, making sure that you pick up the phone, ask the right questions, go see people, and then don't, like for me, I could see where my pitfall would be like motivated reasoning a little bit, right? I want to find the next thing. So maybe putting some guardrails up around myself to make sure that I sort of pump the brakes a little bit and don't get too married to an idea, because I do know that they're a whole lot easier to buy than they are to sell.
They're definitely easier. Yeah, you can always buy them. You can't always sell them when you want.
I find the marks kind of interesting on them too. I sometimes wonder how people are marking their books when I see, a couple shares trade and something shoots up. It's like, is that a real mark? I don't know. It seems like volume weighted marks would be the most accurate way to try to figure out what something's really priced at, but I have no idea.
Yeah. The accountants still haven't figured out mark-to-market accounting. And I don't think they're necessarily equipped for the job, but I mean, it really doesn't matter what these marks are. It's all about drilling into what the business is worth. And I think that's one of the great things about Microcap Club and the space. It draws people who are business analysts. You get people from all sorts of walks of life, like former engineers, music teachers, all sorts of different things. And they get really keen about figuring out how a business is creating economic value. And when you start thinking about that, that's what formulates the right questions to ask when you're doing your due diligence. And it's the flip side of people who are trained at a big university and learn all about efficient markets and then are a total Bloomberg wizard and can build a spreadsheet like you've never seen. Some of those people can develop into awesome business analysts, but when you coming from that different background, different perspective, I think gives people actually an edge over the industry norms, shall we say.
Yeah, that makes sense to me, maybe because I want it to, but I think it actually does. You got your training in private equity, right?
Yeah, I started in the venture space, and I mean, that's really, if you're buying a company and you can't sell it for 10 years, you better make darn sure you want to own it. So,
yes.
Like, talk about liquidity, right? I don't like this anymore. Oops, I can't sell it. See, you got to make sure you really want to own this thing for a long term. And you got to make sure you're partnering with a management team you trust and can get along with for a decade. I mean, you're basically getting married. And it's got to be an industry where you think the tailwinds exist and the dynamics are there, that when you come out the other side of this investment's going to be worth a heck of a lot more. So it's really that fundamental business analyst, which drives the core part of our investment process today. But we practice it a lot more in the public markets than we do in the private, because Mr. Market, I love that guy. Every day he's either giving us chances to buy stuff or sell stuff.
Yeah, I was listening back to, I think it was 2019 when you presented at Lattice Work, and you were saying that you found there to be an abnormal amount of, I shouldn't say an abnormal amount of deals, but you thought that the opportunity set was getting increasingly better. And part of the reason was you were saying like managers that were getting redeemed on were very likely not large growth types, right? It was small cap value in general were the guys that were getting liquidated. So there were marks that were coming out that, a stock would report deceleration in revenue growth from 15 to 12%, but it would be off 40% because there was just no bidder to sell the shares to. How did that that sort of dynamic, what did 2020 do to that dynamic? Did it accelerate it? Was your thesis proven out? How, I guess, from last time I heard a big speech of yours to now, the only thing that I've really heard since is the podcast you did, which I highly recommend people listen to it, on This Week in Intelligent Investing with Elliot and Phil and John. You appeared on that in February, but just kind of curious to hear how things have evolved since 2019.
Yeah, that was an interesting trend. I mean, we saw it start to shake out in 2018. That was a really tough year in the microcap, small cap space. And then 2019, it just kept on going. And, we're sitting there and we're like, wow, this is punishing, like just getting punched in the face every day, because there's not a lot of bid out there for the types of things we are looking at in the space. And 2020, it was interesting because beginning of the year, it looked like the reversal had finally come. I mean, January was actually, the first kind of bit of risk on market where people come down in market cap size. And then, which was, immediately followed with a global pandemic, which blew apart any risk appetite whatsoever. So there was a massive drawdown. If you look at Russell Microcap Index, look at small and microcap managers, it was really ugly. And if you look at how 2020 ended up playing out, it wasn't until October where people started to come back to that market. So where I think we're at today is we've had this extended period of time where large cap has outperformed small cap. We've had a whole bunch of active managers who buy small cap stocks just go out of business. And so we've had this both relative and absolute value opportunity where small caps have been cheap relative to large cap on a relative basis, but also small caps are still cheap on an absolute basis because there's way less people doing the work than there used to be.
And you will also, just so people know, I've heard you talk about Zillow and Stitch Fix, so you're not like simply constrained to small and micro, right? You'll go up market when you see opportunities. Is that a fair statement? Yeah. We like firm wide, we look at the whole spectrum, and my partner Felix Nari did a great presentation last summer on Stitch Fix at MOI. So if anyone's interested in that thing, the Stitch Fix or our large cap strategies, what we do, that's a great place to start. I mean, my approach to large cap, and I kind of joke about Felix because he had a more traditional starting at a bigger firm, following large cap stocks. And now I tease him a bit, and I'm like, hey, you're turning into a venture capitalist. And because when we're looking at a lot of these companies today, I mean, what's important in venture capital? It's like, well, you need a big TAM, and you need a great team, and you need a great product with strong internal economics. So as it scales up, you get the cash flow. And when we looked at Zillow and Stitch Fix and a lot of these things, we just saw pent up opportunity, particularly coming out of the onset of the global pandemic in March. I mean, everybody got excited about Facebook and a bunch of these other companies, Microsoft, where Sacham came out and quote was like, well, we just had 3 years of demand pulled forward into a month, something like that. Yeah. But
there was a period of time where these second tier type tech companies hadn't come back yet. And we've kind of written about it because Fangs was already taken. We needed a cool name. So we came up with Zips. So we've got the Zips.
Hey, I like that.
Yeah.
I like that.
It's kind of zippy.
It is indeed.
How can you tell I'm a dad, hey? My daughter's probably rolling her eyes at me right now. Such a dad joke. There was a second tier of tech company which hadn't been discovered yet. And we last kind of spring, summer, that's where we rotated a lot of our portfolios into opportunities like that, because you could see how the world had changed. When people's behavior changes, I think it's for 62 days, that behavior is usually here to stay. So people are just going to buy more stuff online, including real estate, which is the biggest industry in the world, which is being disrupted by Zillow. So if you want to start with a big TAM, you might as well start with real estate.
Yeah, that one I had avoided because I didn't like how they were holding some of the risk in the flipping business as I understood it. But I was obviously not correct in that, or at least not according to the stock market. I wasn't correct. But I just kind of, I don't know. I think a lot of businesses, when the world stopped, I got a little bit scared of what they were doing. And then maybe I should have pivoted back to opening my mind, a little bit more in June after some of the things that I had owned had re-rated and some other things hadn't. But that's much easier to say in retrospect than it is to do when you're managing through it. I found a couple things held me back. One was taxes a little bit. I really didn't want to just generate a bunch of short-term taxes, which is maybe a mistake that I consistently am making. But the other was I knew that, I had a strong degree of confidence that the businesses that I owned could get through it, and trading that into risk that I didn't fully understand didn't feel like a great idea in the middle of a pandemic. So what a time to manage through, man. They don't exactly write a book on that stuff, do they?
Oh, absolutely not. And I remember in the middle of it, I was journaling every day, and I was saying to our team, I'm like, look, be journaling right now and talk about how you're feeling. It's good to talk about your feelings right now, because in a year or 2 or 3, when this is all over, you're going to look back and be like, oh, that wasn't so bad. Yeah. You go back, I went back a couple weekends ago and reread my notes from a year ago, and it was like, that was way worse than I remember it right now. So actually having it all written out and help giving you that context to prepare for the next time, because there will be a next time. It's going to feel different. You're going to look for similarities, but controlling your behavior and emotions in those period of times, that's what separates the great investors from the good ones. And it's way easier said than done. When we look at what we did, though, reflecting, we weren't looking for new opportunities in that period of time. We were going into places where we'd done a lot of work and we really liked the businesses already. So I think that's another issue, is that when you get into those periods of time, it's really hard to pick up a new idea and drill in and get to the conviction level you need to buy it. Whereas if you've done the work in advance and revisiting those companies that you do know well, then you can actually move quite quickly and capitalize on the opportunities. And fortunately for us and our investors, we did.
Yeah. I have complained about missing Restoration Hardware as one, and Eldorado Resorts was another that I was looking at. I kind of wonder if the playbook gets run again, if it makes sense to allocate to small, when the businesses get almost these really levered businesses that have a lot of concern, does it make sense to sort of spray a portfolio of option bets, right? Because equity has a perpetual duration. And that obviously, unless you get liquidity or bankruptcy, truncates it, right? But that I kind of wonder if that would be the concern. But I kind of wonder if I shouldn't have made a couple more option size bets on some of the the really depressed equity valuations relative to what they would have been normalized. But then again, that could just be resulting. I'm really not sure what the answer is.
Yeah,
easier in retrospect.
It's always easier in retrospect. And we missed so much. There's so much just drives me nuts. There's things we should have bought earlier and things we just didn't buy at all, which just went up crazy. And that's just the nature of what we do. And it's kind of like envy, right? Charlie Munger always talks about it's the worst of the 7 deadly sins. Seeing the stocks going up. Nothing you can do about it anyways. So don't spend too much time fretting about the stuff you missed. Just focus on the stuff you did well. And you had a big bold call that worked out great.
Yeah, well, that's true. And I think that focusing on the next thing is always the most important. We were talking about golf, and that sport taught me a lot, right? Because your last shot doesn't matter at all. And all you need is one bad one as your next one, and an entire round can get derailed. So I definitely agree with that, what you're saying. I guess that I have realized that the wisdom of Buffett and Munger, I realize every year more and more, but that envy statement is very, very real. Sometimes when I find myself not even being able to be proud of what I did last year, which I am pretty proud of, but there are times when I'm like, man, I could have done so much better. It is envy that's driving that conversation internally.
Totally. And it's even harder in the world today. I love Twitter. I have to block myself from using it, right? And
Me too.
there's so many people sharing such great ideas and concepts, and there's so much you can learn about in companies. And then you start hearing about these stocks that are going up and how easy it is and how great it is and all these wonderful track records out there. And it's in a social media world. I mean, envy is even more challenging than it was historically, because the ability to compare yourself to others has never been more prevalent than it is today.
Yeah. And the other thing is, you don't know whether or not the comp's really apples to apples, right? You don't know whether, like, funds have different funds that they market. I mean, people can have different anonymous accounts that they market. Like, you never know. You never know what's reality on the other side of the coin. But I do know there's a lot of good people doing good analysis that are sharing their work. So I appreciate that. I have found over the last couple weeks that the key for me is I need to have blocks of time. And then the other thing that really, I think, impacted my head for a bit was I was feeling the need to respond to everybody that wrote, and it's just getting to a point where it's untenable. Like, it'll just drive me nuts. So, it's kind of tough because on one hand, I want to grow like a fan base and some audience engagement. On the other, I have to sleep, and like I just like found the dopamine really got in it was impacting my sleeping habits. And I was like, all right, this isn't good anymore for me, so have to redefine that relationship.
Yeah, it's hard when the incoming starts to overwhelm you. For the longest time, if a student ever reached out to me, I would set up a call with them and call them back. And I think I mentioned this enough, so I've got a lot of students reaching out to me now because I'd always take a call, and it's now hard for me. I can't respond to everybody, and I carried a whole bunch of guilt because I really wanted to pay it forward. And if there's something unique that comes in, like a great stock pitch or a concept, or they're chatting about something, then it's harder for them to get it. But I do allocate time. To your point, I allocate time for that now, but I can't do it all. And that was hard for me to come over because I felt an obligation there.
Yeah, and you sort of build the brand of being the person that people want to come to. And I mean, I know who you are. You participate in Manual of Ideas. We obviously all sort of market through that, but I also think that there's a common thread of giving to get in that community. But eventually, I just think, to your point, it just gets a little bit overwhelming to field all the questions. So we'll see going forward. I don't know. So one of the things that got me really interested in how you invest, if you don't mind going through some of your past investments, if that's how you want to do it or not. But you said that you're not afraid to get involved in, and I wouldn't say be an activist, but an active investor, and just kind of what that looks like from your standpoint. And I don't know if you have like a favorite outcome that you want to discuss, or even one that went wrong or whatever. I don't have any agenda on it. I'm sure the good ones are more fun to talk about.
Yeah, the ones that go wrong, you end up signing NDAs and you're never allowed to talk about them again.
There you go. I was kind of under one of those for 10 years with the old franchise, but pretty sure that's over now.
Yeah. So I think this really just ties back to being in the private equity world originally. And I mean, yeah, I love finding businesses I love at a cheap price. I also love watching them grow and doing whatever I can to help them grow. So a lot of it is just, as large shareholders of a company, just being actively engaged, talking to the management team and the board and trying to help them out. And we never go into a situation where it's like, we think this management team's incompetent. There's a great company. Let's go in here and shake things up. Life's too short to be getting in fights all the time. What we do look for is where, there's a business we really want to be invested in with a management team that we think has what it takes. And so we've got, obviously there's the constructive side where we're doing whatever we can, making introductions, being active in the public markets. One of the areas CEOs of our portfolio companies are calling me and asking me a lot about is, engaging with the investment community. Who are the investors they should be targeting that they want as long-term supportive shareholders? We chat a lot about that. I think in smaller micro cap companies, when they start looking at mergers, M&A activity and capital allocation, the level of sophistication isn't what it will be at Berkshire Hathaway. So we can provide some input there. Where everybody always gets excited and likes to talk about is when all of a sudden we have a divergence of views with either the board or the management team. And there's one company, I think I can talk about it now, it was an EMR company up here in Canada. And founder was a wonderful entrepreneur, just super passionate about customers. And he came into my office a couple times pitching me on investing in the company. And the first couple times I was like, this thing's going to zero. Over-levered balance sheet, like cash flow I couldn't quite figure out because like deferred revenue and all this stuff. And then he made this acquisition, and we're chatting in December, and I'm like, I look at him, I'm like, but like you can't pay for it. You're going to be bankrupt in March. And he's like, no, I've got this customer payment coming in on this date. And this is just an entrepreneur who was like knew his cash flows, like totally memorized, and was just super passionate about his customers. And all of a sudden in April, I'm waiting for the bankruptcy announcement because I was thinking we might be able to pick the asset up out of bankruptcy. And like, sure enough, he skates through that quarter. And I'm like, okay, this guy knows what he's doing.
Yeah.
And so that's when we initiated a position pretty soon after that, when I was like, okay, this guy's got a vision and he knows where he's going, and we do like the business. He always had a harder time communicating with investors out there. So over the years, this evolved. Company grew, and stock price went up. We continued to support and own the stock, and it seemed like every 2 years somebody would come to us and try and fire him. And so they would come, and I remember he came into our office one day. He's like, Dave, the board fired. He's like, you actually got fired. The board fired me. And I'm like, Al, how'd the board fire you? He's like, well, they fired me. I'm like, but like, you own 30% of the company, and we own 15% of the company, and this other guy owns 15% of the company. Like, they can't fire you. He's like, oh. I'm like, yeah, just go talk to the other guy, and then go to the board and say, 60% of shareholders say I'm not fired.
Yeah.
And it's funny because I reflect on the board at that point in time. It was a whole bunch of really big company people who were used to like corporate governance and procedures. And I asked him, like, well, why did they fire you? It's like, well, because I didn't want to write reports. Like, well, why didn't you want to write reports? He's like, well, I wanted to go sell product. I want to go talk to customers. I'm like, well, I know exactly what you should be doing. So that was a situation where we were able to support the CEO and keep the company on track despite what the board was thinking. And eventually that turned into a great outcome for us. I think we originally built our position at kind of 40 to 60 cents, and then it was sold for over $3, probably 6 or 7 years later. So
nice
situations like that where we're able to work with management team and help support their growth and protect them from people doing silly things.
Are you finding a lot of your ideas are on the venture exchange? Like as a Canadian small cap, like just kind of because, people here may not know, like my listeners tend to be US focused, so they may not even know what the venture exchange is. And if you don't mind just sort of briefly explaining how Canada works and where you're finding ideas.
Yeah. So our major stock exchange is the TSX, and they've got their smaller company board called the Venture Exchange. And what it allows is it's less onerous disclosure requirements and reporting requirements. So basically smaller companies can afford to be public. Like one of the things we've seen in the US with all the regulation coming out of the financial crisis in 08, 09, it's really expensive being a public company down there. And the amount of disclosure you have to provide, it from my perspective, it's wonderful because I get to learn more about companies and industries. But from a company perspective, if you're 50 people in a $10 million company, you're going to spend all your time writing reports for the SEC or the Canadian Securities Exchanges. So in Canada, we've got a junior exchange. There are listing requirements. So there's a lot of quality companies out there. As an active participant in the space, I can confirm that there is a lot of junk out there, stuff that's totally promoted. So you do have to be careful in what you're doing. But the venture exchange it's a straight-laced up. It's a good exchange. But whenever you have an exchange, there are always people who will try to take advantage of the opportunities.
Yeah, and I think, too, there's a perception, at least, that I had to fight against for a while is I would say, well, why is this company so small and public? Like, why didn't they just stay private? You'd spoken a little bit about that, actually, I think, in the February podcast that you did with Elliot and Phil and John, right, where now there's maybe a little bit more incentive to go public because the valuations are maybe a little bit higher in the public market than they previously had been relative to private valuations. Is that a fair characterization of how some of the dynamic is flipped? Like, does that still exist?
Oh yeah, like I don't think there's a private company out there not trying to figure out if they can go public via SPAC or IPO right now. Like all the inside shareholders of these private companies they're seeing the opportunity right now. If you look at the IPO market, the go public market in Canada, there's a very rich pipeline right now. But we've seen last summer, last fall, we were really active in the space because there was that arbitrage where companies going public went public at a price that was probably a discount to what their peers were trading at. And as a result, these companies would go public and their stock prices would go up right away. And reflexivity kicks in and private companies see a whole bunch of people making money and they want some of that. So it's driven a lot more companies to go public. What we're seeing now, though, is the companies that are going public are demanding that, in a lot of cases, the top tick valuation, which, there's no meat on the bones left for the public company investors. So we're not seeing the exciting, stock up 20, 30% right out of the gate, which I think will probably temper the market a little bit. People like doing things when you make money and they're easy. When it's harder to make money, probably see some capital flow away. But the market is still really strong. The setup for this, though, is really, in Canada, we've got this history of financing junior exploration companies, both minerals and oil and gas. So there's the whole ecosystem is set up around financing these companies publicly. And I feel kind of anti-Canadian saying this, but we don't do a lot in the resource space. It's just don't like commodity stocks. But what we've seen is technology companies, healthcare, and just straight up traditional industrial companies going public at a really small stage, for whatever reason, maybe deal with some legacy shareholders, provide liquidity, or maybe just, a stockbroker at a small shop bought them a really nice bottle of wine and a steak dinner and convinced them it was a good idea. We've seen that too.
That doesn't seem like a great reason to go public, but I respect the guy's choice in wine because it made somebody make a pretty big decision based on that. With the venture exchange, do companies get into the quarterly reporting as much, or is that kind of a little bit of a darker market?
No, quarterly reporting is required. There's a bit more leeway. So I think it's 120 days after year end for your year end financials and up to 90, I think, post quarter. So there's just a lot more leeway on the length of time it takes. So it just kind of decreases the burden a little bit. But yes, audited financials and quarterly reports, including management discussion and analysis, which is not as robust as what we'd see in a K or a Q in the US, but still provides some pretty good information on the business.
You know what's funny? I have a couple friends that are in private companies that are VC backed, and they said that the perception of not having quarterly earnings calls is completely wrong. Like I've heard from a number of people, they're like, I have as much short-term pressure on me as I think I'd have if I were public. I think it's maybe a consequence of just having outside capital in general as opposed to whether or not you're public or private. But that may be wrong. My sample size is under 5, so it's not as if I have a huge sample size, but it has been a common refrain.
Yeah, well, if you're in a private company that's private equity or venture backed, you've got a whole bunch of people on the board who are really passionate about your success, and so there will be a lot of pressure. A lot of times the companies you see go public earlier are when you have a CEO who may not want that same level of adult supervision. When you go public at a smaller size in Canada, it's your board may not necessarily be holding you to the highest level of account because they're probably the same people who bought you a steak and a bottle of wine. So certainly in the microcap space, the accountability to the board is probably not as great as in the private space. The reporting obligations are still there, and maybe you're doing a quarterly call, maybe not. A lot of times you do a quarterly call and nobody shows up.
Yeah. Well, that's where the opportunity is for somebody like you, right?
Absolutely.
I mean, if you cover everything and you're the one that shows up, like that's why the opportunity exists.
That's 100% why the opportunity exists. So, and the great part about Canada is, companies are always coming public, and the small cap space is there's always new opportunities presenting themselves. One of the most interesting spaces we find the opportunities when we start to see speculative bubbles forming. And I mean, this is always a fun topic for value investors. People are talking about, Bitcoin right now and how crypto is like, it's a bubble. Well, in Canada, we had a financing window a couple of years ago where a whole bunch of crypto companies and blockchain companies went public. But about the same time, we also had, a big cannabis financing a window open up, and a bunch of these cannabis companies went public in Canada in advance of legalization, and valuations just got crazy in both the cannabis and crypto spaces. But we were sitting there watching a lot of these companies at that point in time, and we kind of ask ourselves, why does a bubble form? And it's because people believe like there's some sort of game changing coming on. There's a massive market opportunity, and this new industry is being created. And what's interesting for us is what I hear when I hear about these bubbles, the first thing I think of is big TAM, big TAM, big TAM. And when we see these companies coming public at a really early stage, they're generally not investable. There's all the promoters get involved. You got these people who took a whole bunch of mining companies into bankruptcy. All of a sudden they're cannabis experts, and then all of a sudden they're crypto experts. You just follow these people around. But the reality is there are companies that are going to come public where you've got, management teams that are really trying to execute on a vision. And so what always happens, and we call it the death spiral zone. As soon as people realize that a lot of these things are not real businesses, or how hard it is to actually build a business, and the fundamentals start to kick in, you'll see your stock price come off 90%. So what we do is spend a lot of our time around these bubbles is trying to figure out which companies have real business models, have high integrity management teams that can actually operate. And when the death spiral happens and these stocks are off 90%, and usually the business, the intrinsic value will start to compound pretty quickly, and you can buy these things super cheap. And it's a great entry point to get into these companies. And so there's a lot of, I love it when these bubbles form in the microcap space, and most people generally love them because they get in long and they ride it up, and then they don't love it because they ride it down. But for us, it gives us that leading indicator that there's, an industry or a company with a big market you can go after, which really helps you find optionality in the microcap space.
Yeah, I like the idea of, and I forget who articulated it the first time that I heard it, but when you look at bubbles, they became bubbles usually because there was a grain of truth that just kind of got taken too far, right? And I think that my framework of how things can go up and come back down really quickly is that grain of truth starts to get proven out, and then people that haven't done the work start to pile in, and then the momentum gets going, right? And then on the way down, there's a lot of weak hands, and then people get flushed out, and then funds have to sort of liquidate that position there's a lot of reasons that people don't want to have internal conversations and whatever. And that's when I think that the grain of truth that started the bubble is unlikely to be as affected nearly as much as the price of the securities that are reflecting the euphoria and depression of the bubble and the subsequent popping. So I do like the idea of starting to look and then being ready on the downside. I mean, I know Canadian cannabis got decimated. Aaron and I had talked about the U.S. cannabis. I think that's kind of that's an interesting setup from the opposite standpoint, because I just think that a flood of capital may be unleashed, but there's a lot of hard questions to answer between today and what the end state looks like. But I don't know that you need to have all of them answered in order to have a view on whether or not, there's a good investment or not. But that'll be TBD. I think it's an interesting space. Yeah,
it's interesting. I was listening to that, and Aaron and I have two Canada-listed U.S. cannabis companies in common. And he made an interesting statement that really resonated with me. And he talked about having, when he's buying stocks, it's like, buying limited downside, but uncertainty to the upside. And like what we talk a lot about is on the uncertainty of the upside is what does the right tail look like? Because when you look at historical stock market returns, it's a really small subset of the public company universe, which drives a ton of the returns. And it's finding those outliers, those right tail type events. And so whenever you can find these companies with these big TAMs, and if they have a decent probability of hitting it, that's when you can really get a ton of really positive skew into your portfolio. Where when these things start to kick in, I love the way Aaron articulated that.
Yeah. Do you think that maybe? I guess when I came into value or into investing generally, I studied the books of value investing, and I was like, okay, focus on the downside. But then I don't think that I put enough emphasis on, well, what does the right tail potentially look like? And then how are the probabilities assigned here? And like, that's how I think, Sean Stannard Stockton sidestepped a lot of the carnage that came in consumer packaged goods, because I think he was early to notice that the skew had shifted. And I think that at least when I started, and I think it's a fair comment on values, sort of generally, one of the mistakes is not getting creative enough to see the true skew, because you have to let your mind drift to the upside. And I think sometimes in such a downside-focused practice, that skill set is underweighted a little bit, or if not underweighted, under-discussed, and then maybe underemphasized. Does that make any sense to what you think about the world, or am I off there?
No, that makes a ton of sense to me. I think people, when they get into value investing, it's reading security analysis, and there's a lot of balance sheet statement analysis, and people are looking for a formula. And I mean, investing is an art, because the future is uncertain, and the value of a company today is the value of the future cash flows, and nobody knows what those are. And you have to put some thought into what that is.
Yeah.
And I think if you look at the historical data, there were more traditional industry type companies where you could do traditional value analysis 40, 50 years ago than there are today. I mean, so much more of the companies today are people-based businesses. So if you just look at randomness 50 years ago in this universe of companies you're going to look at, if you didn't pay too much, and then a bunch of these companies had some right tail events, you were going to generate some good returns. Just call it probability, call it luck, call it whatever you want to. In the world today, more of these traditional companies they're being bought out by Danaher or some industrial like roll-ups who are like want to buy like best of breed product in a small market, number 1 or 2 market share. A lot of these high quality companies that would be traditional value investments just aren't in the public markets anymore. So the opportunity set you're dealing with today is different than it was 40 to 50 years ago. I could be totally wrong, but that's the way I look at traditional value investing today. Not to say it's dead. I mean, we found a company on the TSX that was trading, at 25% of its real estate value, and they bought the real estate in like 1970 when it was like in the middle of farmland, and today it's like up and coming suburb in Toronto. So you can still kind of do value investing, particularly in the microcap space, but I think the game has changed, and if you don't change how you look at things, you're probably going to get left behind.
Yeah, I am certain that's right, at least as certain as I am on anything. When I heard you speaking about something, you had said that as you look at your portfolio, the higher quality names have generated a little bit more alpha. And if I'm not mistaken, you said, I don't know if that's sort of like a comment on where we are in the market, but one of the things that I've come to appreciate a little bit better is how much easier the higher quality businesses are to underwrite. So what is perceived as a 70-cent dollar in a quality name may actually truly be a 70-cent dollar, as opposed to like a 50-cent dollar that's actually not really a dollar, right? So the bargain is maybe a little easier to identify in some of the higher quality names. Potentially a late cycle comment, but that's kind of where I've morphed as an investor.
Yeah, it's certainly where I continue to morph. To your point, though, I mean, with everybody saying, never sell and compounders are the way to go, there's just this mean contrarian streak in me where I'm like, okay, this has to be overcooked right now. So
yeah,
let's not give up on the other side of buying 50-cent dollars. Let's make sure we're doing a little bit of that. But yeah, I think if you do look over the long term, it's the compounders, like the businesses where the internal economics are growing at mid-teens. And if you buy those at a reasonable price, just sit on them forever. I mean, that's way easier than picking up quarters every single day and trying to find the next opportunity, and then tax leakage and all the other aspects that go into it. So that's just me totally sitting on the fence and waffling on the topic, Bill.
I get it. I think that's the right thing to do, actually. And I, the other thing that I've sort of thought about in my own portfolio is I've thought, okay, well, I try to think about what kind of risks I'm taking. And I think that having some quality and some special situations sprinkled in can truly diversify the portfolio risk, right? It doesn't all have to be one way or the other, but I do think that for a long, long time, the right tail was underappreciated. Maybe it's overappreciated now, but we'll sort of see over the long term. What did COVID and the government responses do to your perception of like real left tail risk, if anything? I haven't heard you talk about this, but I'd be interested to hear you riff on it, especially as somebody that's in small cap land. I got to think that in March that was kind of terrifying, right? Because access to capital dries up for the smaller guys quicker than the bigger guys, I would assume.
Yeah. There was zero access to capital in the small cap space last March. And my political commentary is weak on a good day. But I mean, I do love studying incentives. And I know that if you are in politics and you are in power, the only thing you want to do is stay in power. And if you stay in power, if everybody has jobs and things are okay. So you're going to use any tool at your disposal to make sure that people have jobs and they're okay and they're not hurt financially, so you can get reelected, so you can continue to have power. With that kind of underpinning, I just kind of expect government to keep on coming in. I mean, they wrote the playbook in 0809. It was delayed but effective. And man, did they unleash it with a fury in March, April last year. And
yeah, that was pretty impressive.
Yeah. And I mean, listening to some of your recent guests like Preston, there's second order consequences of what's going on, both from a society perspective and also from an investment perspective.
Yeah, I don't know at all how to handicap what is actually going on, how I can have a strong macro view. I didn't even know at the time how big of an impact the stimulus and policy response would have. I am I think I've gotten myself to the point where when I saw the markets reacting the way that they were, I realized that there was probably something I didn't understand, as opposed to like just saying, oh, this is crazy. But I do think, and this is like famous last words, but I do think they did a good job chopping off like the true left tail. Now, that's not to say that there won't be consequences to the actions, right? Nothing is free of consequence, but we were looking at a potentially really devastating event. And I'm not saying that things are good right now. I know there's a lot of people that are suffering, but I'd rather be reopening into what we are than some alternative reality where there was no support.
Totally agree.
That would be tough. Yeah. Do you think, just circling back to your past as a private equity investor, do you feel as though the public markets are as long-term focused as people like to say they are, or do you think that there's longer-term focus in some of like the private equity type ownership? I'm kind of curious to hear you riff on that a little bit, because it seems like everybody's long-term until stuff happens in public markets, right? And as soon as stock prices start going down, the long-term theory really gets thrown out the window. But you're somebody who's done it and lived with companies for a long time, right? You've seen successful exits. So I'm just kind of curious how you see it.
Yeah, I mean, we saw this great study done where you can add about 200 basis points of outperformance over the long term if you have high active share, and your long duration. And the top decile of long duration was a holding period of 2 years. So long-termism in the public markets is 2 years. So we're looking 5 to 10 years out. So I kind of get amused when you think of 98% of the world out there is trading out of positions every 2 years. It's totally insane. And I think there's a great book that came out. Lawrence Cunningham wrote Quality Shareholders. And I mean, it's so important for companies to attract the right types of shareholders. People that understand their business and are going to be there both in the good times and the bad times. It creates a way easier operating environment for the CEO and the board and the management team. And conversely, like in our business, I mean, having quality investors. I mean, we couldn't have executed on our investment strategy last year if we didn't have great long-term investors in our funds. And one of the things we spend a lot of our time trying to figure out is how do we continue to nourish these relationships and build stronger, stronger relationships with like-minded long-term investors so that we can match the asset to the liability, for lack of better words. But I mean, it's just so important in the world today, because if you have a long-term perspective, you absolutely can outperform. My compliance loves it when I use absolutely, by the way. Sorry about that. You can outperform. You potentially can outperform. But the flip side is that you need to be invested in companies that are thinking that way, and you need a investor partner base that is supporting you throughout that. So it's long-termism is in the stock markets. It's not prevalent, which is good, because if everybody was doing it, the opportunity would be arbed away.
Yeah. When you're going through sort of the portfolio management process, right? So you've already bought a name. This is such a hard question to ask because it's situation dependent, but how often are you sort of re-underwriting your original thesis? And like, what do you do in situations where a stock just like really rips on you? I'm looking at March and thinking, oh, well, if I can make 15% over 5 years on a bet, that's amazing, right? And then all of a sudden it doubles in under a year, and it's like, okay, well, there's, my 5 years of return basically compressed into under 6 months. How have you sort of trained yourself to be an owner and be a little bit, I don't know if agnostic to the market is the right word, but hold through periods of over and under valuation? Because I really, from what I know of you, I really respect how you invest and how you own companies that you own. You're not a trader.
Yeah. So this answer always drives my team nuts, but it depends. So when we look at our opportunity set, in the more traditional value world where we're picking up $1 for 50 cents, we call those, a bunch of other people do too, close the discount situations. And that's when our primary source of return is being driven by price movement, mean reversion, and a closing of the gap to what we think the intrinsic value is. If it gets close to fully valued, we're gone. Otherwise, you're just setting yourself up to round trip. In compounders, to use an overused word, when the internal economics in the business is growing and intrinsic value is increasing, that's when we will, when it gets to fair value, we will trim the position. So like in one of our larger cap mandates, I run between a 3 and a 6% weighting. And if high quality company we want to own for a long period of time is super cheap, it'll be at 6%. If it's fully valued, we'll carry it at about 3%. Because the error of omission we can make as investors, and I kind of talked about the right tail, there's all this. I don't think we can actually ever fully appreciate the right tail. And companies that are doing all the right things, like you don't know what little skunk works they have going on, or what added product functionality, which actually may totally expand their TAM, or may like just totally decimate one of their customers. Like, you don't know what's going on. And so these companies that are doing all the right things and have the history of doing all the right things and continuing to compound intrinsic value, you kind of have to give them the benefit of the doubt. So when they do hit the estimate of intrinsic value, I mean, don't be high conviction, 20% weighting on it, but dial it back and hold on to it, because the odds are they've probably done something right. And I mean, we've looked at Starbucks. Felix covered it, for 20 years, and there was a company that all through the 90s, it would have looked expensive if you didn't understand the unit economics of the business, and we're looking at headline numbers. So Was it a good thing to have sold Starbucks in 1998? Absolutely not. And I think like one company we've talked about recently is a company called Barr Technologies. Savneet Singh's CEO, and really focus in the restaurant point of sale space. And we had our bull case scenario built out, and then they went and bought this company called Punch, which increases their exposure in the supply chain to restaurants, where now they're on the customer loyalty side as well. And so they add that acquisition in, and then we look at our bull case, and our bull case has to change quite dramatically. So even though where it was kind of fairly valued based on what we thought, we were maintaining a position because for those previous reasons, we didn't know what they were doing that would potentially add value over the longer term. And then we found out, and then we were really happy we owned the stock.
Yeah, that makes sense. I had talked to Sanjay Ayer about the thesis creep a little bit, and he said, like, of course your thesis is going to creep, right? If you own something for so long, you can't possibly have the same thesis at the end of it, at the end of your ownership period as you did going in, because so much has changed. That's an element that I haven't really had to deal with outside of, like, I guess Berkshire, but that's not really thesis creep, right? That's just like they're going to figure this out because it's Buffett and co. And like they know how to think through this stuff. It's not that much more complicated there.
Well, I feel like I feel like we need to talk to Rishi about this one, because he's like, he turned me on to thinking in systems and systems. And when good things are happening to companies, there's positive feedback loops that are happening. And so if you're revising your thesis upwards with positive events happening, that might be an okay thing to do. I think where I get really nervous is on the downside, where it's like, your stock's trading at $2, news release comes out, they lose a customer that's 10% of revenue, and the stock's down 30%. And the most dangerous thing I ever heard is the price is baked in, news is baked into the price. And I think it's the flip side, whereas we've had a negative thesis defining event happen, and so your intrinsic value is going down, but you don't know what actually led to that. To that customer loss. I mean, maybe their product sucks. Maybe it's like end of life cycle and they never invested in the next product. Maybe they got some like salesperson that drives everybody in industry nuts and nobody wants to do business with them. And so the odds are, your next revision of your thesis is probably down. So one of the things we really try to focus on is if you have to re-underwrite and your thesis on the downside, it's probably time to move on.
Yeah. I'm almost certain Bill Miller wrote about this, and I think that the way that he framed it, or it was his firm, I think they said like they went back and looked at when their portfolio underperformed, or a position in the portfolio underperformed, and it's almost always company fell short of underwriting projections. We held on because we thought the stock, like you said, adequately reflected the reduction, right? And Sanjay touched on this too when he talked. He said, like, nobody ever models the reality of fade because it always happens like quicker. And I think how he said it, I may be putting words in his mouth, but in years 3, 4, and 5, that compounding of deceleration, you just don't capture it in the model in the same way that reality occurs, right? Another thing that I was thinking about is people say, because the books, like, oh, well, let's go Henry Singleton and I want a cheap stock. But when I was at the bank, I can tell you morale is not great when the stock is languishing. And like, that's a very real thing among employees that's maybe under discussed, I think, sometimes among investment professionals, at least the ones that I talk to. I certainly don't think that you need to like be promotional on your stock necessarily, but if I was at a company and I was running it, I would try to do everything that I could to have my stock trading in a fair range. One, I think it's better currency for M&A. And two, like I wouldn't want employees thinking that they were what's our company doing? Well, look at our share price. It sucks. So the market hates us. So we suck. Like that stuff's very real. I believe in that interplay of feedback a lot more than I used to.
I totally agree. It's a great point, Bill. If your employees are like coming to work and they're they're upset because their neighbor's making way more on their stock options than they are, or their ESOP or whatever the stock compensation plan is, they're going to be slightly less motivated. And it's I mean, the flip side is like when you're all of a sudden you make $10 million on your stock options overnight, you might have a hard time concentrating at work. You might just be looking at a stock screen. But having
that's true.
It's I hope that's happening to a lot of the listeners out there.
Yeah, well, and I hope all the employees at my companies, I hope they're all having that problem, right? Because then I'm having good problems too. But alas, many are not. I apologize.
Yeah, but like having an active, engaged workforce, and particularly in the world today, where most of these are people-based businesses, financial services, healthcare, technology. The majority of all companies now are very people-based, particularly in the North American markets. It's so critical. And we try to get a feel for it through Glassdoor and other tools we use. It's an imperfect science, but very meaningful, I think, to the outcome of our investments.
How many people are on your team, on your investment team? Like, do you have a lot of junior people? What's your firm look like? What's it like to run a firm is where I'm really going with this, and training people up, and what's it been like during COVID? Those are really the questions that I was going to ask you. I just led it with all of them.
Yeah. So there's 4 of us who are lead PMs, and then 8 analysts supporting the PMs. But what I would say is our PMs are all analysts. I mean, we're all people who are ripping apart companies and understanding businesses. Some of us also just have to have the added stress of making decisions on what goes in the portfolios. Running an investment management firm through COVID, it was a lot of fun if you like a lot of stress. The most important thing for me as a leader was, to make sure that everybody was behaving rationally. And what was interesting is because we went work from home on March 12th. And so everybody was at home, and there's a lot of fear going on at that point in time. But people were able to kind of hang out in their home office and just read and tune things out and stay very rational throughout a very irrational period of time. But there was a lot of checking in, and Felix, our CIO, was talking to everybody on the investment team, and we changed because we couldn't have in-person meetings anymore. So how do we actually create that water cooler talk about stocks? And so we created some different ad hoc meetings and whatnot, which have just actually, I think our level of conversation is more focused and higher than it's ever been on the investment team. So it's it's been a positive development for our team in a really unfortunate time. The fun part about running a fund company, though, is probably because I'm talking fast with a lot of excitement right now. I love investing, and what's great for me, and I love going to the MOI events. I mean, you go there and you can talk stocks, and everybody there is way smarter than me. I just sit there, I listen as much as I can, and I'm just in awe. I'm like, wow, you did that much work on that name. It's so impressive, right? And for me, I mean, I started my career in Vancouver, and there's 2 places you can work out here, and I guess they didn't want anything to do with me, so I had to figure out how to do it on my own. And so, we started in venture, and I led the firm transitioning into the traditional fund management in 2009. And it's been for me, it's I've always loved having conversations like this, Bill, and with other investors out there who do deep work and are really passionate and have a bit of a value bias. And so for me, as we build the firm out, it's an ability to attract like-minded investors. If you want to come talk about cheap stocks that are great companies all day long, it's a great place. And the problem is 95% of people in our industry are in it to get rich. They're not going to fit in at Pender. You just got to want to come and look at stocks all day long. And that also supports when we talked about long-termism, you need the organizational structure and discipline to achieve that. And luckily for me, I've been able to create an environment where I've brought Felix over, who's probably one of the smartest investors I know and just ridiculously underfollowed online. And as we build this out, attracting other people to an environment where we just get to talk about stocks and focus on long-term investing all day. So I think you really hit my passionate hot button there, Bill.
How did you start it up? you left private equity, right? And what, you had a theory that you could affect change, or I refer to you, I associate you as an activist, and I know you're not, because I know that has a hostile tone to it, and that's not what you do. But I'm just trying to think about like what you were thinking when you were becoming an emerging manager, and how you thought about starting, what has clearly been a successful run.
Yeah. So I was working with a team I joined Pender in 2003, and we were focused on the venture space. And then when 2007-8 came along.
Real quick, when you say the venture space, do you mean the venture exchange, or
venture
do you
capital?
Mean like venture capital?
Venture capital, yeah.
Okay.
And so 2008 came around, and the two guys I was working with at the time were 55 and 65. And where I'd spent a lot of my time from 03 to 07 was on venture exchange listed technology companies. Because what we saw was, coming out of 2000, there was a bunch of companies that went public in 99, 2000 that they went public too early, and then they were just absolutely orphaned. Like, an investor wouldn't even call them every 3 years, which meant the prices were dirt cheap. I mean, there was one company, Gemcom Software, and I remember it was doing $20 million of revenue. I think it was $1 million of free cash flow, had about $4 million in the bank, trading at like a $4 million market cap, and growing at 20% year over year. I mean, it's like absolute no brainer.
Wow.
And so I was following a lot of these small public companies, and what I saw, like the people in the venture space in Canada, they always turned their nose up to the public companies. There was a bit of disdain. And meanwhile, they're paying like $100 million for some guy's idea because they thought they were the next Mark Zuckerberg. And I'm like, well, I'd way rather pay like $5-6 million for this like $20 million business that's kicking out $1 million of free cash flow, growing at 20%.
That's actually working today.
Yeah.
Right? Yeah.
You guys do you. So we started to build a pretty good track record in that small public tech space. And when 07, 08, I went to Kelly, who's our chairman, and I was like, hey, I want to start a small cap hedge fund. And he's like, oh, okay. And so I was thinking of leaving Pender. And the next morning he came back and he's like, do you want to partner? And for me, I'm in Vancouver. There's not a lot of infrastructure out here. And to have Kelly and Bill, 55, 65-year-old guys at the time, who were venture capitalists. So what they loved doing is they loved financing and helping build individuals who are trying to build companies. So
that's cool. So you were their venture investment.
Yeah. And so they're two great guys. I knew them and trusted them, and they provided capital and help and experience. And Kelly was active in the business till about 2015, and is now our chairman. But it's been that was really the foundation towards in 2009 when we launched my small cap fund.
Huh. That's a very cool story. That's nice that you didn't have to go outside of what you already knew in order to accomplish a goal, and be able to stay partnered with people that you respect. It's a good way to spring load your starting conditions, as someone that I know said once.
Yes. Yeah. Not ever. I feel very fortunate to have had that opportunity.
Yeah, that's cool. Well, then all you had to do was execute, right? Just make sure not to mess it up.
Yeah. Great idea. Just don't mess up.
That's right. I mean, what do you think makes you so successful? I mean, I know that I think, like, when I think about you, I like the framework that you look at, the presentations that you have pitched and made, even ones that I think are maybe like a little bit underloved in like the deeper value type names. I really like that. I always think you're thinking through skew, and I always think that you're really passionate about what you're talking about, and I think that you're always willing to go in places that others aren't looking. Now, maybe that's hyperbolic, but that's at least what I've seen from the pitches. Do you think that there's a thread or something that you do uniquely well that has enabled you to succeed for so long?
Well, it's kind of you to say that, Bill. I
think John thinks it too, man. I mean, you have a high profile on that community, and I don't think he does that lightly, and I think you warrant it.
Yeah. I think it kind of boils down to this woman I met in business school, and her name was Rebecca Langstaff. And here I am in business school. I move out to Toronto, and all these like super aggressive 90% guys. Everybody's so smart. And I'm in class and I'm listening to this Rebecca talk, and I'm like, and she was an artist, did a fine arts undergrad degree, and people were like, what's she doing here? Blah, blah, blah. And like, she was lights out, the smartest person in the class. Like, just probably one of the smartest people I've met in my life. And right away, I'm like, this artist is getting accounting faster than me. Right. So it was just like, okay, there's people way smarter out there than me and then you get all these, and then the rest of the class, it's all these people who are working 100 hours a week and just, they've been thinking about it every day since they were like 16 years old. And I'm a failed doctor, for crying out loud. It took me a while to figure out what I was going to do. So, I mean, it's just always having, whenever you're looking at something, always knowing you're probably wrong. And I think that just kind of leads into, making sure the probabilities are skewed in your favor, because investing is probabilistic. And when you know you're probably wrong, you really got to make sure the probabilities are in your favor. And I think it kind of resonates a bit with what Munger says, where it's like, just avoid stupidity. So if you can avoid doing something really stupid, which hopefully I've avoided so far. I've done some stupid things. It just hasn't left too much of a damage in the portfolios, fortunately. I think that's a terrible answer. I don't like talking about myself, Bill. I'm sorry.
Okay. Yeah. Well, I apologize for making you do it, but
that was a really uncomfortable ramble.
I don't know. I don't think so. What's funny is I think that I know that and I think that some others I approached life from I'm right for far too long. And then once I realized that I wasn't right, I started to realize how wrong I actually was. And now I'm terrified, even in the things that I think that I'm correct about. I sort of have been able to be like, all right, well, I'm probably wrong, and I just hope I'm not the idiot at the table, And I think that a lot of the conversations that I've had with people over the past year, as I've kind of grown into more of my own investor that I'm proud of, has been like this struggling with imposter syndrome, right? And being like, man, I don't even know if I belong at the table with the people that I talk to. I think that's a common characteristic among the people that I really look up to. I don't think that there's too many people that I really look up to that have been like, yeah, I'm the shit and I've always known it. Like almost all of them have said things like, I'm not the smartest person in the room when I'm in rooms, or, I assume I'm incorrect. I think that's a very healthy attitude. I think it's probably necessary to longevity in a risk-taking business, because otherwise I think it's too easy to bet big on the wrong bet. Yeah,
they've written books about that.
Well, what did Bruce Berkowitz used to say? Bruce Berkowitz always used to say the thing that's terrifying is it's the next bet that's going to kill you, right? And then, I don't know. I'll let him talk about his own experience, but I think that's an interesting case study.
Yeah.
Enough said on that. So what do you want to talk about, man? This is a two-way conversation. I don't want you to feel like you just have to talk about you, but I'm really happy that you're on here, so I'm down to talk about anything you want.
Yeah. So that question is always difficult, Bill, on kind of the investment success we've had. And I think for us, the most important thing is to be principles based in our approach. And I think everybody's always looking for the magic formula, and the world's changing. It's always changed. What worked in 1900 didn't work in 1920, didn't work in 1950. And the more you can kind of focus on the principles for success, and I view value investing as a principle. And for us, the principle is understand the value of a business or a security and buy it at an appropriate margin of safety. It doesn't mean buy shitty, broken down industrial companies at liquidation value. Like nobody ever said that. It's always like just assess the quality and the price, the value of the business, and get it at a reasonable price. And like there's a lot of other principles that come into play as well. I mean, it's looking for companies with big TAMs, and the things that always change though are it's like how how are companies going after? Like, what are the products? What are the services they're selling? Because that's always changing. And I remember, in the kind of the mid 2000s, early like part of 2010, 2011, 13, before, SaaS companies, everybody started getting excited. Like Buffett came out and said, I don't invest in technology companies because I don't understand them. And that's a great statement for him to make. Like he understands his circle of competence, and he's got so many opportunities outside of technology. Like he doesn't need to go there. But what I always found interesting is there was a whole bunch of value investors out there, and they were like, "Oh yeah, Buffett said don't buy technology companies," and because if he can't understand them, then I'm not smart enough to understand them. And like that's not what he was saying at all. He was just like defining his circle of competence, and he's playing so many levels ahead of us. He probably was saying that to give himself some like public some bias on if he says it publicly, then he won't go out and buy something even though he's tempted to because he knows he doesn't understand it, or he may not understand it as well as he thought. But Buffett's always preached principles, and I think that gets lost a little bit when people are looking for a formula or an easy way to make money, or what's the system we're going to use right now to capitalize on this market. And it's the wonderful thing about a market is it's almost like a biological system. It's always changing. New entrants are coming in. There's new competition. The world's growing. The world's changing. People change. So it's really focusing on the principles, which is what we always try to do. It's bringing our investment process back to first principles. And is it applicable to what we're doing today?
How much of focusing on principles, if you had to weight it, I know it's not like a science, but is model driven versus qualitative driven? And how do you sort of, integrate? I mean, obviously they're interrelated, but I'm just trying to get a sense of like how much of what you do is sort of hard model driven principles versus sort of softer stuff.
Yeah. So on the close the discount situations, it would be way more valuation price driven. So way more quantitative. On compounders are, it's about 40 to 50% price valuation driven, price driven, a quantitative, and then 50 to 60% qualitative factors. So, when we're assessing the weighted IRR of any of the companies in our portfolio, 50 to 60% is attributed to qualitative factors. I think we're spending the majority of our time on that 50 to 60%. I mean, I think a lot of the quantitative stuff, if you can't get it off Bloomberg now or do it pretty quickly, I mean, you probably shouldn't be in this industry. So it's spending your time on the qualitative stuff. So we spend, even though it's about 50 to 60% of the compounder input, it's, a way larger percentage of our output time.
No, that makes sense, because I think that's where the real insight comes from. And that's the stuff that actually the numbers start to mean something. Like you have to understand that stuff in order to make the numbers mean anything. Otherwise, you're just throwing, numbers on a board. I think for a while I was so concerned with buying something cheap. I flashing back to your broken down industrial comment, that I totally underweighted. And Rishi is somebody that has helped me get this out of my head. But the agency costs associated with those kind of situations. And then the other thing that I totally didn't understand is just like how expensive it is to liquidate something. And, that's thankfully I've gotten less ignorant over time. But I think some of the books, when I read the words on the paper, I didn't understand what they actually meant. I think as I'm starting to understand them a little better, I'm realizing how much more important the qualitative stuff is than I ever appreciated before. Also, the people behind things. I don't understand the idea of not talking to management or other investors about things. Now, I'm not saying that everyone needs to talk to those people, but for me, I need to talk to other people because I need to be able to triangulate who to trust, who not to trust. That's just how I have to do things.
Yeah.
Obviously, the risk is you get sold a story that you shouldn't have believed, right? But I don't know any other way to... That's sort of the risk I have to take.
Yeah. Whenever you talk to management, it's always a risk you have to take. And it's interesting, like when you look at larger cap companies, though, you're probably going to get a way smoother CEO who is totally talking on point and is going to communicate to you exactly what they want you to know. and try to influence you. And they're probably very skilled at it. Whereas, we, in our neck of the woods, when we get into the smaller companies, a lot of the CEOs and they're just running flat out trying to build their business. And they're just going to have a really authentic conversation with you about their business, which is great because then they end up getting shareholders that understand their business and want to support them. The truth is usually somewhere in the middle. When you're talking to a CEO, you've got the person who's fully transparent, the person who's trying to, to try and influence you to buy their stock or sell you a bag of hammers. And it's having the filters to try and differentiate which is which can avoid you from the heartaches out there.
One thing that I would think would be kind of tough about this space, and I see it in other tech companies too, is if you have that CEO that's passionate and can talk about the business. What do you do when that CEO turns over and you're long, and it's like, okay, well, now are you typically involved in some of those discussions? I mean, the one that's like ringing out to me right now is there's a founder of a tech company that just left, and it's like, what do you do in that scenario, right? Because so much is bet on the founder, but then at the same time, he or she isn't everything in the organization, right? So managing that turnover has got to be kind of a uncomfortable time, if or an uncertain maybe is the best word. I don't know.
Yeah, it depends. It like we
I mean, this is the art of it all, right?
Yeah. And I mean, we've watched a lot of companies grow over the years. And I mean, if you look at a tech company, a lot of the really successful tech companies are the founder is someone who totally nails product market fit. And so they're the product visionary, the champion. And that's what you need to get a company started. I mean, you need to get that nailed, and then get some customers, start getting cash flow, and then start scaling up. At what point does that founder either lose the capability or the interest in continuing to scale the company up? And so that's when you get into it. Is it voluntary or is it involuntary? And then it's the assessment of the, how robust a process was it bringing the next person in. So then you have to look at the new person coming in, and then the dynamics come into play of, well, how much has the founder really stepped aside? Are they still on the board? Do they have a relationship with the incoming person? I mean, we kind of mentioned Stitch Fix. I mean, founder stepped aside as CEO, but they've been nurturing an incoming CEO for a while now, and they've worked together. So they clearly feel they have a good fit, and allows founder to focus on product and special projects, which is totally their passion. I get it. I mean, we're at Pender, we just hired a president because I way rather wake up every day finding a new stock to invest in or talk to you about investing than figuring out how to continue to support the growth of Pender. So we're doing our own transition as we speak. And what's been very interesting from my perspective with it all is we've been the outside observer watching other companies do this sort of transition. And I kind of, all the pitfalls, and you see how things go wrong. And so when I'm going through this process, I'm like, am I the founder just saying this and actually doing this? Like there's so much self-reflection that goes on, but we've seen so many companies do it well and so many companies do it poorly. So, hopefully we've stacked the probabilities in our favor that we've done it very well, but check in a couple of years. We got a great candidate. So I think we probably did.
I also think that being able to turn or to step aside and to say, you know what, this is what I actually want to do. I've gotten a company to this point. Now I need, rather than be the quarterback, maybe I need a good quarterback because maybe I don't want to be quarterback anymore. Like, that's a sign of leadership. There aren't that many people that are willing to step aside and maybe sacrifice some prestige and title for the betterment of an organization and to better their lives. Like, I mean, some people probably just don't want all of the pressure for their entire life. So understanding how much of that's reality, how much of that's just a story is real key. Yeah.
Yeah.
I could see that.
Yeah.
That's cool.
Yeah. It's funny. I'm driven much more by happiness than I am by power and prestige. So the more I can do to structure my day to do the things I want to do, the happier I'm going to be. And
it's probably a pretty good lesson for people to drill into their heads.
It's
something I find this among a lot of, and I don't mean to say value investors because I don't think that that's fair, right? I'm sure that there are who are some firms that people like really respect, like Polling Capital. I think, I mean, like some of these growthy guys, WCM, like those guys. So I don't want to. I encompass value encompasses them when I'm saying this, at least to the extent that I understand. And really within Manual of Ideas, I've seen an abnormal amount of people that say things similar to what you just said, right? That like they're driven by the enjoyment of the game more than what they actually get out of it. And I think that that's a cool community to find myself in the middle of. I don't quite know how it happened, but a lot of it tracks back to Berkshire, and then a lot of it tracks back to John and Manual of Ideas. It's just been great.
Yeah. Well, I mean, you're a part of that community because that's who you are. I mean, I remember I just go back to that first time I met you, and like all you wanted to do is talk about stocks. You loved it. And
yeah,
here
my
we are
wife
today.
doesn't like that. That's all that I want to do. But it is true. Sometimes I think she's like, we do have anniversaries and stuff that would be nice for you to pay attention to, which is a fair criticism. But I'm also the person she married, and I have been since she married me.
Yeah. It's a lifelong journey. We all know what we got into.
That's right. Well, man, do you want to talk about anything else, or you want to wrap this one up? You can always come back on, and I'm happy to keep chatting. I don't have an agenda with these things.
Yeah.
And I like how that last segment ended.
Yeah. Well, why don't we just leave people wanting more? This has been so much fun.
I like it. I like it very much, and I do appreciate it. How can people get in touch with you and find you?
On Twitter, I am at PenderDave. Easiest way to reach me since I'm totally addicted to Twitter. Disclosure, I'm so addicted I had to go buy the stock last year. So
I am in the same boat, although I paid more than you did, unfortunately. But I hope that we both work out okay on that. I will tell you, man, I had to really adjust how I've been using it. I don't know. It's been a weird year. We were talking about it a little bit before, but going from like really nobody, I'm still nobody. Don't get it twisted. But 18 months ago or whatever, nobody knew who I was. And then Toby put me on, and that was awesome. And then I don't know, the whole deal with Robinhood really like raised my profile in ways that I wish it didn't. But like it's one of those things. I'm still not sure that I processed everything that's gone on, and I think that some of my potential Twitter addiction has crept into my sleep and stuff. I'm going to need to revamp how I interact with the platform so that I can live a long and healthy life and not just a dopamine crazy one.
Yeah.
But I do like it, and it's a hell of a place to meet people.
Yeah. I could just imagine what your DMs look like. I've taken the extreme step of deleting Twitter from my phone every now and again. So I can't actually access it except for when I'm at my computer, but I generally give in and reinstall it.
Yeah, I think less on the phone is huge. My DMs aren't so bad unless I do something that I kind of like. I interviewed Preston Pish, and I knew that would tick off some of the listeners. I apologize if you're still listening and I ticked you off. I'm sorry, but part of the reason that I did that was I really respect the call. Like that guy, that took a lot of courage for him to make the call that he made. I don't really have like a view on Bitcoin. It's kind of cool to me, I guess. I like that other people like it. It's interesting because it's interesting to me, but like that's as far as it goes. I don't need to be the Bitcoin arbiter of truth. And I guess that what I need to be better about with this podcast is saying, I understand that you wish that I had asked different questions, but like that's not my podcast. I'm not interested in the intrinsic value of Bitcoin. Like that's not even the conversation I wanted to have. And I had the one I wanted to have, and I hope that you'll stay with it. I guess that what I need to be more healthy about is realizing that some of the feedback is people trying to help and not necessarily like people coming at me necessarily. I think that's been the one thing that I probably need to improve on. But I don't know that you asked that question. That's just something that I've noticed.
Yeah. Well, I think the reality is you're having some fantastic, authentic conversations. I mean, I love listening to the pod, and they're going to take the direction they are. And I think you're going to have some upset listeners as a result, because people, there are some opinions expressed on this podcast. And
that's true.
I think the great part is, like, I don't agree with all the opinions on here, but to have an open mind and listen to them and understand where you may be wrong. If the only thing you take away from Preston's podcast is there's 21 million Bitcoins and it could be worth like $100 trillion market. I mean, there's a right tail skew that is worth thinking about for more than 10 seconds. Like, don't just dismiss that.
Yeah.
Think about that, because if it does play out, there are some tremendous opportunities. And we were talking about envy earlier. Be forewarned, there may be some envy kicking in if what Preston says is potentially true. So just do some.
The thing that's crazy.
Sorry.
The thing that's crazy to me too is, like, people. There are some people that still write me and they're like, "Well, he's not right," and it's like, okay, look, I understand that you say, like, his version of where the world may not be right today. He was buying in 2015. Over 6 years, that's like up 200x. We're still going to argue over whether or not that's, like, even if it's wrong, there's something to learn from that. There's something to learn from identifying hugely asymmetric upside opportunities where maybe you don't have to be right for the precise reason, but you can still make a lot of money. I'd rather be wrong and rich than right and begging for a re-rating somewhere. Like, that sounds horrible. So that's kind of why I wanted to do that interview. I don't know. So I just need to be better about saying it's my show. I'm sorry if it upsets you. Because I'm not trying to upset anybody. You know what I mean? I'm trying to have good conversations. It's coming from a good place.
Absolutely. And that, there will be opinions. There will be upset people. I think if you could just, when you get like all that negative feedback, can you please let me know? Because I'd like to take the other side of that trade. Like, when people are just like that passionate about stuff and, that can't possibly be right, that means there's probably something to it.
Yeah, well, that's the Adam Robinson thing, right? Like, things that make no sense and things that are blatantly obvious are sort of the places to play. I really like that thought. That was one of the core thoughts that I wanted to explore with him. And, there's some questions that when I listen to these, I wish that I could follow up on and have a different question path. But part of what makes it good, I think, is that it's not scripted. And sort of the cost of being unscripted is they're not going to be perfect in retrospect. But I like how the conversations weave. So I'm not going to change it.
Yeah, please don't.
Okay, I won't. But
I feel like we're at a con. Like, when I'm listening to your podcast, I feel like I'm having I'm at a conference and getting to know these people alongside you. And I mean, I think that's a great takeaway, because it helps. In a world where it's hard to build relationships, you can get to know people.
Yeah, that's right. And a lot of the times it's about the people behind it. Like, whatever we talked about today, I mean, I'd go back and listen to the whole thing. But what I know that I can tell people is, like, I think you are a high integrity individual that is doing something different than the other guests in a different geography than I'm used to. And I think that you're somebody people should at least listen to and get to know. That's the only promise, right? Like, that's it. And hopefully it's enjoyable for people to listen to. But I think sometimes managing what I'm going to have to manage going forward is, like, if somebody's on the podcast, that doesn't mean it's an endorsement of what they're saying, right? Like, I don't necessarily agree with everything, but I'm also not going to be like a huge dick to somebody if I don't agree. I'll try to push back a little bit, but I'm okay with just leaving something out there that I don't have to fact check, right? On the other hand, I'm not trying to just like sow disinformation or whatever. So I don't know. It's going to be an interesting needle to thread going forward.
Yeah. Well, I'm sure you'll do a great job handling it, as I'm sure you'll do a great job handling the growth of the Brewster Media empire. I'm looking forward to continuing to follow along.
Well, I appreciate it. We may need to SPAC this thing so I can have a liquidity event.
Oh. I love SPACs.
Yeah, they're pretty interesting. I've gotten That's another thing that came out of this pod. There's a lot of things that I used to look at and be like, a SPAC is a great example of something I used to look at and say the founders are out here looking to rake people over the coals. I don't disagree that the founder shares are very, very cheap in SPACs. I have started to understand why SPACs exist and why companies are going public via them. And, like everything in finance, there's going to be bad outcomes and good outcomes. But I used to dismiss them all. Now I'm kind of looking for SPACs that are trading close to trust value where the warrants are going to separate. And it's like, okay, well, if they can do an interesting deal, maybe that's asymmetric upside for me. And if we're close to trust value, I don't have much downside. Famous last words.
Nope. I totally agree. In SPACs, there's a lot of fundamental investors out there that they can't get their head over the fact that there's those founder shares there, and they find it so egregious that they won't touch it, and they'll get all. I bet if you had a bunch of SPAC guests on here, you'd get a whole bunch of your listeners upset that you're promoting SPACs.
All riled.
Oh yeah, all hot and bothered. But I mean, if I could buy a SPAC at $5, I'm going to do it all day long. I mean, because then I just wait for a transaction and then I vote against and I get my money. I double my money. That's a great investment. And and similarly, I think what's changed in the SPAC universe, to your point, Bill, is the quality of companies that used to go public via SPAC were somewhere between garbage and, now they're attracting there's a way higher quality of company going out there with some of the promoters and founders who are putting these SPACs together. So, there's some high quality businesses coming public via SPAC. And so that what we know from kind of the SPAC experience the previous 10 years, it's actually different. And then from a probabilistic standpoint, if you're buying it at $10 and sell the stock, get the warrant, they do a good deal. I mean, you got very limited downside and a whole bunch of optionality. That's a good bet.
Yeah, that's how I'm trying to think through it. Especially for some of the excess cash that I have in the portfolio, because I almost look at valuations generally, and I hate to be one of these guys, but I don't know that there's a huge amount of opportunity cost to tying up, some capital if you're somewhat near trust value and have limited downside. I'm just not sure that that's not a good bet right now, so I'm placing a couple of them. Or I guess I should say it more affirmatively. I think it is a good bet, so I'm placing a couple of them, right? So we'll see how it all turns out. Until then, thank you very much for stopping by, Dave. I appreciate it.
Thank you, Bill. I'm looking forward to doing this in person soon when we can travel again.
As am I. Indeed. Take care of yourself, and until next time, thank you.
Take care, Bill.